Well, Apple shares climbing higher this morning after topping estimates in the second quarter, but saw total sales fall over 4%, and iPhone sales in particular declined 10% from a year ago. The tech giant did, however, announce it authorized a $110 billion share buyback. Martin Yang, who is the Oppenheimer Senior Analyst of Emerging Technologies and Services, joins us now. Martin, great to see you here this morning. So perhaps it was better than feared in some cases, plus buoyed by this buyback that was announced as well. I mean, all things considered, how should investors still be evaluating Apple right now?
Sure. So I think you started framing this exactly what I thought is, with iPhone a cycle likely going out of the trough, and then with a stronger shareholder return program that will stabilize investor sentiment. And from here now, we're going to enter into a stronger iPhone cycle with accelerating earnings growth from low single digits to double digits, and likely will put Apple, the stock, on a premium valuation versus S&P.
Martin, I just have to throw this number out when we're talking about the buyback, because I think it puts this in context. The $110 billion buyback, by the way, is from the Journal, more than the market cap of most S&P 500 companies. I mean, that just tells you the size of it and why we're seeing this kind of bump on the back of the results. At the end of the day, though, this is a company that's still being judged very much on iPhone sales. Is that a risk when you consider ultimately that these upgrade cycles are slowing, even if the expectation is there is going to be one super cycle coming out of AI?
I think the upgrade cycle is definitely lengthening when you look at the past maybe 5 to 10 years time horizon. But at the same time, we are seeing a very steady increase of Apple's services growing as a percentage of both revenue and profit. So with each new cycle, Apple is able to strengthen its position regarding services, allowing more users and to subscribe to more services and pay more per service and per subscriber. So this is not only an iPhone story, but an iPhone Plus services story.
And so at what point do you foresee services, I mean, we've been tracking this getting, back in 2020 to an $80 billion run rate, and now we're looking full speed ahead at when this is going to get to a $100 billion run rate even. I mean, what type of timeline do you think Apple is on to be able to reach some of those high marks, and then those margins pass back through to other elements of the business that they'd like to see grow up?
We're already going to see services passing $100 billion run rate in 2 quarters, according to our estimates. So that $100 billion mark is very easy to break through. And when you think about how Apple will allocate the additional profit generated by services, I think for now, in the near term, I think it will be wise to plow the profit back into investment into AI as well as machine learning, both on the infrastructure as well as on consumer-facing applications and features on the phones.
Martin, what's the next big catalyst, you think, for the stock?
In early June, there are two. I think it's twofold. The smaller catalyst, what we'll see in next week, where we are going to see the new generation of iPad Pro launching. And this will be iPad with not only a new display, but also expected to have a very capable laptop grade chip. So you'll see a very exciting development and evolution in the form of iPad next week, and then in June, that's the bigger catalyst. At WWDC 2024, we'll see Apple formally announcing really Gen AI features that will come to the next iPhone.
What does the evolution of the headset need to look like? I mean, people who have one, it sounds like they enjoy it, but the price tag needs to come down. I mean, for me, it's kind of clunky right now. So what do you need to see to have confidence that that could be a significant contributor to Apple's bottom line in the future?
Now, I have no confidence in Vision Pro or similar headsets becoming a significant contributor to Apple in the next 5 years. There are some serious, very difficult physical problems to solve regarding optics and how you can present a very comfortable visual experience for our average consumer, and those are really difficult problems. I don't see near-term solutions for those. So the weight and form factors is going to be too much of a barrier for Apple to break through in the next 3 to 5 years.
Are they wasting their time then, sinking cash into that venture and that part of the business?
No, so that's exactly what Apple should do as one of the most financially resource-rich company, because they are investing not only for near-term projects but longer term. Eventually, they will need to push forward on new form factors, new ways for us to think about new form factors for personal computing, and wearables is definitely one of the key directions that makes sense because it really liberate our hands. Allow us to be more productive.
Martin Yang, Oppenheimer Senior Analyst of Emerging Technologies and Services. Good to get your insights today. Appreciate the time.
Thanks for having me.